Welcome to this latest episode of Damien's Midweek Markets, the show where I talk about what's been going on in investment markets and what to look out for in the weeks ahead. Now, if you're listening to this on YouTube, or I should say watching this on YouTube, please make sure you hit that like button if you find it useful or interesting in any way, and also subscribe to our channel. But if you listen to this via a podcast, so you just got the audio, then make sure you go and leave us a 5-star review on your podcast app of choice. Now, if you recall last month's video, we entered November with optimism, but also with potential hurdles to overcome. And that optimism was because we were entering the best 6 months of the year for stock markets, which meant that if seasonality continued to exert its influence over investment markets as it had done in previous months, then November was likely to be positive for US stock markets in particular, but then in turn for global equity markets. But there were the potential hurdles, which included the US midterm elections, which passed by without much consequence to investment markets in the end. And of course, we had some new inflation data, which was eagerly awaited, especially in the US. Now, I mentioned last time that if the inflation data came in higher than expected, it was likely to be bad news for bonds and equities. But of course, the converse was also true. And as it turns out, US inflation data published during November undershot analysts' expectations and pretty much lit a firework under investment markets. Now, the softer inflation data sparked a large-scale shift in the market narrative. Now, when I say that, I mean the narrative surrounding interest rate hikes. And also that had a knock-on effect to asset allocations. Now, the Fed pivot was back on. And by that, I mean the markets began pricing in that the Federal Reserve in America would start taking a more dovish stance, maybe reining in its interest rate hikes and eventually maybe even cutting them into next year and 2024. And as a result, we saw some extreme one-day moves in bond and equity markets in the hours after that data come out. We saw a 5.3% rally in the S&P 500, which was the best day since April 2020. There was a 7.5% rally in the tech-heavy NASDAQ, which again was the best day since 2020. And the US Treasury yield saw its biggest one-day drop since 2009. So I'm looking at the 10-year US Treasury yield there. And we saw some epic moves in currency markets. In fact, from the low in November, the pound rallied 8% against the US dollar. Now, to further illustrate the scale of the market shift during the rest of November, if you took November's performance rankings of asset classes, they were the complete inverse almost of the rankings for the period that covered January to the end of October. So what we'd seen up until that point in 2022, we got the inverse in November. So the worst performing sectors all year, which was Chinese equities, became the best performing sector in November as we had that reopening trade going on where people were betting on China reducing its COVID restrictions and opening up again. And we also saw a rebound in UK index-linked gilts. Going back to Chinese equities, actually, that was a 20% rally we saw in those in November, which is mind-boggling. If we go to the other end of the scale, the worst performing sectors in November was those that were exposed to Latin American equities because of that commodity exposure. Well, they were the best performing asset class up until the end of October. So everything was turned on its head. So as November progressed, markets started to look for a sense of direction because we had those explosive moves. Now, in the end, equity markets broke higher again after US Federal Reserve Chair Jerome Powell gave a news conference in the final days of the month, which the market interpreted as dovish in nature. So one of the big trends in investment markets during 2022 has been US dollar strength. Now, if you call up a chart on your phone, you can use a desktop, but if you Google or search for DXY, which is the US dollar index, and you look at the year-to-date version of that chart, you will see that we've got a chart that goes almost single-mindedly upwards to hit a multi-decade peak in the autumn before collapsing in October. Now, whenever the dollar has rallied, the S&P 500 has fallen and vice versa. And since mid-October, the US dollar index has been falling. So it's no surprise then that the S&P 500 has been rallying hard. And if there's one chart to keep an eye on at the moment, then it's the US dollar index. And with the US dollar index weakening further after those November US inflation numbers and then Powell's speech, it meant that we closed out November with the second successive month of gains for not only US stock markets but also global stock markets. I mean, even Asian equities, which had a negative October, had their best month in years. And in fact, the Hong Kong's Hang Seng Index had its best month since October 1998. So we're going back a long way. To give you a further idea, the MSCI Asia Index ex-Japan finished November up 15.37%. You look at emerging markets, the equivalent index was up 11.5%. The DAX in Germany was up 8.63%. The FTSE 100 up 6.74%. The S&P 500 rallied, but it was up 5.34%, while the Nikkei 225 finished November up 1.38%. Now, the last one there was obviously hindered by the weakening dollar, because it meant that the yen strengthened against the US dollar, which is always bad for Japanese exporters. So that's why we see the Nikkei 225 struggle. But if you are looking at those numbers and you're looking at your portfolio and you're wondering why you do not see the numbers that I just mentioned in the returns on your funds, and especially the US equity ones, it is because of the strengthening of the pound, and especially against the dollar, as I mentioned earlier, that would have reduced those returns. And in fact, it actually would have completely eradicated them in some cases. Now, it does mean that historical seasonality struck once again in November, with bond and equity markets close to breaking out of their 2022 downtrends as we enter December. Again, if you go to the US market, there's a beautiful line where if you look at the S&P 500, you can see the lower highs that are happening throughout 2022. And we're right back there again, testing that downtrend. And if markets continue to follow that historical pattern, as we've done in recent months, then investors will be banking on a strong December for equities. Now, back in 2020, I published a research article for 80/20 investor members that looked at the odds of a positive December. So we'll call that the Santa rally. There are different definitions of a Santa rally. Usually can be just the period after Christmas into the new year that be classed as a Santa rally. But we're going to, for this example, we're going to look at the whole of December. Now, the odds of a positive one in the US, take the S&P 500 again as an example, was 73%, which is pretty impressive. But there has been evidence that in recent years, the Santa rally has lost some of its potency. Now, while December is now the third best month of the year for US equity returns, it had previously been the best month of the year before that. And that was because, well, the change and moving to third was because of a 9.2% drop we saw in December 2018. Now, interestingly, US equities also fare well under the Santa rally. So they actually fare better than their US counterparts, although we tend to associate the Santa rally with US equities. But UK equities do also. And in that research I carried out back in 2020, I looked at the numbers, and actually the FTSE 100 tends to rally about 1.84% on average in December, which is almost twice what you saw on the S&P 500 and almost 3 times what you see on the Nasdaq 100. So FTSE 100 and the Santa rally, there's a good chance it could happen. In fact, the odds are actually better in the UK than the US. In fact, the odds are 85% chance that the FTSE 100 will finish up for this December. Now, another positive omen for stock markets is that the S&P 500 closed out November above its 10-month moving average. Again, that's a research piece I did for 80/20 investor members. If you search Navigating Market Tops and Bottoms on the Money to the Masses website, you can, in fact, find a link to that research, and you can take out a free trial if you like. But it's a good indicator that has been fairly reliable that if the S&P 500 actually closes above its 10-month moving average at the end of a month, it can be a sign that you could buy back into the market, a positive, so calling a market bottom in this case, and we saw that at the end of November. But as I say, it's not foolproof. The other thing is that we saw the S&P 500 close above its 200-day moving average in recent days, which is the first time it's done that in this bear market. So going back to March was the last time we saw the S&P 500 back above that 200-day moving average. But as ever in December, there are hurdles to overcome. The US Federal Reserve will actually deliver its latest monetary policy decision. That's on the 14th of December. While the Bank of England, so for the UK, will be really worried about this because of mortgages. the Bank of England and the European Central Bank, so the ECB, will deliver theirs the next day, which is the 15th of December. So these will likely determine whether investors see a Santa rally in stock markets or not. But also, it will determine what happens in bond markets into the year end. But bear in mind that much of the euphoria during October and November was the result of investors front-running and pricing in a dovish pivot from central banks, particularly the Fed. So if we get any hint that the Fed's monetary policy outlook is more hawkish than currently priced in, then we could see markets unravel. But of course, if they're dovish, then assumptions are confirmed that we are going to get a pivot, then stocks will likely take off into the year end. And I know what most people will be hoping for. Interestingly, back in 2018, the unseasonal slump in US equities actually occurred partly as a result of a more dovish Jerome Powell at that point, hinting that the Fed would likely make fewer rate hikes in 2019 after having already made 4 rate hikes in 2018. So there are similarities with this year. I don't want to sort of be the Grinch, but there are similarities with 2018 and compared to 2022. So we'll hope it won't be a bad omen. Interestingly, in the early days of December, already we've got onto the wrong foot. The S&P 500 has finished down on the first 4 trading days this month, which is something we've not seen occur in any month since September 2018. Make of that what you will. Now, the catalyst for the negativity we saw in the last couple of days has been economic data once again in the US, which suggested that the jobs market was actually hotter than people had predicted. So the job market was stronger. And so that started people questioning their dovish pivot narrative. We've been here before. So it means that we are at a spot where the markets are overreacting to every bit of economic data before questioning or creating a narrative around monetary policy decisions in the future from global central banks. So that's likely to continue. Now, at the end of the last video, I provided some technical analysis insights which people liked, which are basically the numbers to keep an eye on, the FTSE 100 and the S&P 500. This time I'll throw in the US dollar index, given that I've mentioned it. Now, on the US dollar index, keep an eye on its 200-day moving average and a key support line around 105, because if it breaks below that, then it could weaken further, which would be positive for risk assets. On the S&P 500, to the upside, 4042, so 4042 is a 200-day moving average, and 4062 just above that is an important line of resistance. So if we can get above that, then maybe we can build a base to push higher. Beyond that, we've got to look at 4,100 and 4,150, which will prove probably troublesome on the way up. On the downside, watch out for 3,920 and 3,900. We're currently around about 3,940 as I make this video. For the FTSE 100, it did actually recapture that 7,300 level that I mentioned previously, which was about where the 200-day moving average also happened to be. It quickly rose to 7,500, as it usually does once it breaks above 7,300. And that's where it currently sits. So we want the FTSE 100 to hold that and not to break below the 7,500 level. Otherwise, we might be revisiting 7,300. Now, it means all in all, equity markets are now on the cusp of breaking out of some of 2022's most established downtrends. That's globally, not just in the UK or the US, that's around the world. But it will likely need a Santa rally just to get us over that line. So maybe the Santa rally is even more important this year than it has been in the past. And one final thought I want to leave you with. Bond markets, keep an eye on bond yields, 10-year US Treasury yield and the equivalent in the UK, the gilt yield. In recent days, we've seen yields moving without much reference to the direction of equity markets. Now, when equity markets tumbled after the hawkish jobs number in the US, bond yields didn't really react, and it suggests that the bond markets might be becoming less worried about inflation proving sticky, and in fact are planning or predicting that the central banks will be forced to actually limit further rate rises, particularly in the US, and maybe potentially have to consider a new rate cutting cycle. It's early days, but when the bond market starts to focus on something, and particularly on a recession at the moment, then it often pays to listen. Now, that is it for this episode of Damien's Market update. There'll be a new one in the new year, probably the second week of January, just to give me a chance to get back in the new year and see what's going on with investment markets. If you found this useful, please make sure you hit that like button. As I mentioned at the start of the show, leave any comments. And if you're listening via the podcast apps, then please give us a lovely 5-star rating.